Asian markets rising sharply, cheering the Fed's decision to hold rates steady, albeit at a 22-year high for the second consecutive time. That's as the central bank tries to tame high inflation, which came off the back of the COVID-19 pandemic, but also of the Russia-Ukraine war. There are now signs of economic growth, while labour market conditions and inflation remain above the central bank's target. European markets are also heading for a higher open as investors react positively to the Fed's decision. For more on this now, let's get to Neil Wilson, who is Finalto Chief Market Analyst in London. Thank you very much for joining us today. Neil, we are seeing a very positive market reaction for equity and bonds. Why? What did the market like that much?
Well, I think we're expecting the Fed to maybe sound a tad more hawkish, so leaning towards signaling that there's probably one more hike coming up. But that's certainly what the Fed kind of indicated in September. That's kind of what the market's been expecting. And I think yesterday what we got from the Fed was just a little bit more caution and concern, and just a signal that maybe there's not another hike coming in. So that's why we saw the front end of the yield curve moving quite as rapidly as we did. So the 2-year note yield moving quite aggressively lower, and that's what really buoyed the market. So I think as well the messaging from the Fed in its statement, there was a slight adjustment there. It mentioned not just credit conditions tightening, so bank lending and so on to businesses and consumers, but also financial conditions. So these sort of worries about the sort of stability of financial markets as well. So if that's something that the Fed's looking at, then that suggests they're maybe going to be a bit more cautious than they have been, and that really there's no need for them to be pushing rates higher right now. They can wait and see what's going to happen.
Right, Neil, so a sign of caution you are saying, but considering the geopolitical environment right now, what do you expect going forward? One more hike, or have we reached the top and that will be it?
So I think with regards to all the central banks, the major central banks, your ECB, Bank of England, and so on, the bar for hiking again is getting higher and higher. So each time each month that goes by, it seems that we're getting further away from them hiking again. So the question now is when they're going to cut, and I think that's what the markets are going to be looking at. That could be quite bullish for markets, but the question is just how much impact on the real economy do these hikes that we've already had, what sort of impact are they still to have on the real economy, and what sort of drawdowns do we see as a result of that?